When you think of classic American food, Kraft Heinz is everywhere. From ketchup on your fries to mac and cheese on your table. Their brands like Oscar Mayer and Philadelphia dominate grocery aisles and reach over 190 countries. The Kraft Heinz we know today was born from a massive 2015 merger, orchestrated by Warren Buffett's Berkshire Hathaway and 3G Capital. The plan combined marketing muscle with ruthless cost-cutting to create a food empire. On paper, it was a recipe for success, fifth largest food and beverage company in the world. For investors, Kraft Heinz is easy to understand. They sell food people buy every week. Their strategy centers on pantry staples, creating steady, predictable revenue. But does that stability mean strong returns for investors? We'll break down Kraft Heinz's wild ride, its celebrated merger, dramatic fall, and slow recovery. We'll analyze the numbers, compare it to rivals, and look at the future. Is Kraft Heinz a sleeping giant or a value trap? By the end, you'll know if it deserves a spot in your portfolio for 2025 and beyond. Let's dive in. Smash the like button for the algorithm. Let's get started. Kraft Heinz's stock story is a lesson in hype versus reality. After the 2015 merger, Wall Street was thrilled. Shares soared to nearly $100 by 2017. Aggressive cost-cutting boosted short-term profits but slashed marketing and innovation. As consumer tastes shifted to healthier, fresher options, Kraft Heinz lagged behind. The stock began a painful slide. In 2019, disaster struck, a $15.4 billion write-down, a dividend cut, and an SEC investigation. Shares crashed over 27% in a day, falling into the $20s. Since then, recovery has been slow. A new CEO shifted focus to brand investment and innovation. The stock now trades around $36, stuck in a show-me phase. Kraft Heinz has stabilized but hasn't proven it can grow. The past decade is a reminder, even giants with famous backers can stumble. Investors are still waiting for a real turnaround. The question, can Kraft Heinz reignite growth? Let's weigh the pros and cons of Kraft Heinz. The pros: iconic brands like Heinz Ketchup and Kraft Mac and Cheese create loyalty and predictable sales. The company pays a solid dividend, around 4.5%, making it attractive for income-focused investors. But the cons are big growth is stagnant, with flat revenues and aging brands. Younger consumers want fresher, healthier options. Kraft Heinz also carries heavy debt from the merger, about $19 billion. High debt limits flexibility and adds risk, especially if the economy turns. The company's challenge: reignite growth while managing debt. For investors, it's a bet on stability and dividends, not explosive returns. If you want steady income, it's worth a look. If you want growth, look elsewhere. Kraft Heinz faces tough rivals: Mondelez, General Mills, and Conagra. Mondelez dominates global snacks with brands like Oreo and Cadbury, and outpaces Kraft Heinz in growth. General Mills adapts quickly, expanding into pet food and healthier options. Conagra revitalized its brands and innovated in frozen foods, outperforming Kraft Heinz. Kraft Heinz remains a giant in condiments and cheese, but lags in innovation. Its peers are more agile and have found new growth avenues. For investors, Kraft Heinz is a turnaround story. The bet: can it learn from competitors and unlock its potential? Right now, it's trailing the pack. The next moves are critical. Let's break down Kraft Heinz's finances. Revenue has been flat, about $27 billion a year since 2018. Flat sales make it hard to excite investors. Profit margins were high after the merger, but inflation and rising costs have squeezed them. The company hesitated to raise prices, hurting profitability. Debt remains a big issue, though it's down from $30 billion to under $20 billion. Less debt means less risk, but it's still a heavy burden. The bright spot: strong, steady cash flow. Kraft Heinz generates reliable cash, funding dividends and debt payments. This stability is its main appeal for investors. But without growth, the upside is limited. The financials show a safe, slow-moving giant, not a rocket ship. For now, it's about stability, not excitement. Kraft Heinz knows it can't rely on old hits forever. It's pushing innovation: plant-based hot dogs, new ketchup flavors, and easy meal solutions for busy families. The company is expanding its away-from-home business, supplying restaurants and stadiums. This diversifies revenue and boosts brand visibility. International growth is key. Emerging markets like Brazil and China offer big opportunities. Kraft Heinz tailors products to local tastes and builds new distribution networks. Technology is another focus, using data to spot trends and streamline operations. The goal, become more agile and responsive. These moves are crucial for breaking out of the low-growth rut. Success depends on execution. The seeds are planted, but will they grow? Only time will tell. What could Kraft Heinz look like in 2030, 2040, or 2050? By 2030, success hinges on innovation and global expansion. If plant-based and healthier products take off, the company could regain favor. By 2040, sustainability and personalization will dominate food trends. Kraft Heinz must cut its carbon footprint and use tech to tailor products. By 2050, feeding a population of 10 billion is both a challenge and an opportunity. Kraft Heinz could lead in affordable, sustainable foods, or risk irrelevance. The company must shift from cost-cutting to constant innovation. Balancing legacy brands with future investments is key. Adaptation will decide if it thrives or fades. The next 25 years are a true test. Will Kraft Heinz evolve or become a relic? Could Kraft Heinz stock, now at $36, ever hit $1,000 by 2050? That would require nearly 28x growth, about 14% a year for 25 years. That's tech company territory, not typical for packaged food giants. To get there, earnings would need to grow over 13% annually, every year, for decades. For a company with flat sales, that's extremely unlikely. It would take revolutionary products, global dominance, and sustained high profits. Betting on this scenario is pure speculation. Realistically, Kraft Heinz is a high-yield, low-growth stock. Buy it for dividends and stability, not explosive gains. Do your own research, read reports, listen to calls, compare to competitors. This is a long-term, slow-moving investment. Don't expect a get-rich-quick story. Focus on what Kraft Heinz is, not what you wish it could be.